Let's move on now to James Thorne, Chief Capital Market Strategist, Senior Portfolio Manager, Caldwell Investment Management. James, thanks so much for finding time this weekend, and what a perfect time to get you on.
Thanks for having me, and after those quotes, gee whiz, hopefully we can just go up from there, right? I mean, that's pretty depressing when you think about it.
Well, I mean, I can't, just on a personal level, I have been appalled at the candidate choice, but I've not been surprised at it. I think this is part of a much bigger trend. And I said earlier in an interview that I said if I was trying to devise a presidential election campaign designed to decrease trust in government, I don't know if I could have done this well.
And what's interesting, when you think about it and you stand back, everybody wants to invest in the United States. The U.S. dollar has had this really strong bull run. And yet, if you stand back and look at it, there's a lot of concerns coming out of that economy, that political process. And so it's really interesting to sit there and think about, well, why would everybody be buying the U.S. dollar here if what we're watching is a political system slowly but surely disintegrate before our eyes?
Well, I'm wondering if it's because I'd still rather be in the U.S. than France. It's a comparative thing, or Germany. And I think the EU is in tremendous trouble here. I mean, they've got that referendum coming up in Italy, I think December 4th off the top of my head. But come on, if that's defeated, I think you're seeing another fall of government there. You got the Austrian election where it looks like the anti-EU Freedom Party is going to win unless they rig that one. So, I mean, it must be a comparative thing is all I'm saying.
It is, and yet when you think about it, where we think the interesting thing and what people are missing on is what's going on in China. And yes, we know. Let's put it on the table. Jim Chanos, the famed short seller, is out there banging the drum about the excessive level of debt in China. So let's accept that fact, but put it over to the side. We talk about the fact that there's all this helicopter money, and are we going to get helicopter money? Well, China is essentially controlled economy. And what's happening there, I think, is a couple of things that is very interesting. One is one of my bugaboos, Michael, is that the global economy is closed. We don't export to another planet yet, so therefore the deficits and surpluses must equal out. And what we need is, with a global economy that's so imbalanced, we need somebody or something to start cutting out the excess capacity. Well, China did that with respect to their coal mining companies, and they basically shut down 1,000 coal mining companies. That, if you stop right there, they started importing. But where did they start importing? Well, I don't know if you and your listeners have been talking about. They imported a record amount from North Korea, going around the UN sanctions. But that's not the big. The big narrative is there's still 1 billion people in China making less than $4 a day, and the big concern there is civil unrest and civil war, and they need to increase the standard of living in that area of the world, and the way they're going to do it is through a massive infrastructure build in Eurasia, where they're going to be spending I've heard numbers between $20 to $25 trillion for infrastructure spend in Eurasia. And going back, and this is Brzezinski's talked about this, and the politicians have been talking about this. If you control Eurasia, you control the world. So, yes, China's cutting down their manufacturing or the building of their coal-fired generation plants. They're financing 50 in Eurasia. So what we're really interesting to see is the dynamics here about, in the very, very short term, where you're starting to see bottlenecks in the commodity area, specifically coal. I mean, met coal is up over $260 a met ton, a short ton. Thermal, Glencore just signed a deal for over $100 a ton. You start plugging those numbers into spreadsheets, and companies like Teck, right? They're going to do, if they lock in at $150 a short ton, they're going to do $4 billion in EBITDA. Locally in Vancouver, you've got the West Shore terminals, right? And we're just listening to your newscast. We're getting back into the not in my backyard. There was supposed to be a coal terminal built in the United States on the Oregon coast. It's not going to be built. What are all the coal companies going to do to get to Asia? They're going through Vancouver. So we're in a very interesting period of time. And remember, what China does, it exports to the world. So inflation is starting to pick up in China. Commodity prices are starting to pick up. Copper prices are starting to firm. So this is going to be a very, very interesting point in time for investors. Remember, people hate commodities. CFAs and portfolio managers can't stand them, but yet they're really cheap, even after the ride that they've had off the bottom since March 2016.
I'm talking with James Thorne. He's the Chief Capital Market Strategist and Senior Portfolio Manager for Caldwell Investment Management. James, it reminds me here that, for example, I'm looking at this very short-term mix in the U.S. with uncertainty surrounding whether it's Donald Trump and his erratic policy pronouncements, or it's Hillary Clinton going to be under investigation for the end of time with these revelations coming out, including today. But then you've got the Fed, what is it, an 80% chance of raising interest rates coming out of the Fed. And I'm sort of thinking, is what you've just said a reason why you take advantage of these sort of short-term disruptions and playing the longer-term trend?
I think you're absolutely right, because if you look at the United, and I like to value markets, right? And so when you look at the Canadian, and I use a thing it started by Robert Shiller out of Yale called cyclically adjusted price earnings ratio, where you normalize or you smooth out the earnings over a cycle. And then you basically guess or you forecast what expected rates of return are going to be. Well, in Canada, the CAPE is about 18, which forecasts out to be about a 5% rate of return in equities over the next 10 years. In the United States, it's like 26 or 27, which means basically no rates of return in equities over the next 10 years. But yet, we have had a record sell-off in the market coming into this election. And I know the polls in the United States are saying it's a close election. I just think the demographics go against Mr. Trump. And I think a lot of his policies are very interesting. And I think he's an agent of change. I just think the demographics go against him. And he won't win. And it's going to be very, very close. But I just can't see the Hispanics and the African Americans. I just don't think he can run those battleground states. So you have the market selling off. You've got if you look at it in terms of the Electoral College, it's very difficult for Mr. Trump to win. No doubt in my mind what you're talking about after the fact if Mrs. Clinton gets in and what's happening with the Clinton Initiative and all that type of thing, which really means there's going to be political uncertainty in a market, right? That is very expensive. Absolutely. Which is very expensive. And here's another kicker. What if Draghi wakes up one morning and smells the coffee and says, we're going to start tapering? And so I would suggest a lot of asset allocators from big shops use these indicators that I've used. So, for example, in Brazil, the CAPE is about 8. That's about 11% return. China, it's 11. That's a 9% return. Russia is 5. That's a 15% return. So if we get this a short-term commodity cycle going, political uncertainty in the United States, very, very crowded trades in the U.S. dollar, and very, very crowded trades in safe U.S. assets. And what we're also seeing, we're talking, when I build a portfolio, I have 3 big things we talk about. One is the 80-year debt cycle. The other is the business cycle. Michael, when you look at, and one of the great forecasters of the business cycle is the ISM, the Purchasing Manager Institute's a number that comes out at the beginning of every month. They're accelerating in Asia, they're accelerating in Europe, and they're flat to declining in the United States. And to position yourself short term, you can look at I call the emotions, because I think markets are driven by human beings. And you can ask yourself the question, are the economic numbers coming in better or worse than expected? And on Friday, we had the jobs number in the United States. Even though it showed good job growth, it was less than expectations. And so and one of the variables your listeners can use is called the Citigroup Economic Surprise Index. In the United States, the surprise index has been negative and turning negative. That's an indicator of people being too bullish on the United States. Yet at the same point in time, the economic surprise index in Europe and in Asia, in China, is positive. And so I come from the school where it's not the best asset that necessarily makes the best investment. It's when the asset is priced for going to zero, or a company is going to go to bankruptcy, and it's not. It's just going to become a really terrible company. And what I think is going to happen is people are going to recognize this. People have started to recognize this. And lastly, I think Yellen, which we can't trust. I mean, the last speech she talked about was she reprocessed this paper from 1972 by Arthur Occam on what's called the high-pressure economics. If I was your analyst, I'd come into you and say, you know what, Michael, she's not going to raise rates, and because she's using this paper that says the unemployment rate's got to get below 3% to get productivity growth. Here's the point, and this is what's happened around the world. Nobody can trust what she says. And if this was a company, if the Federal Reserve was a company, we'd sell it. We wouldn't go, we said, we can't trust them. We don't want to listen to them. This is too hard. They have no credibility. Even the people out of the Australian Central Bank used a term called them specifically. There are central bankers around the world that are inflation nutters, right? And we have too many of those on the Federal Reserve right now. Now, hold on. If inflation gets to 10%, we got a big problem. I just don't see that happening in a global economy where we've got so much excess capacity.
This is absolutely fascinating. By the way, Caldwell Investment Management, they do funds for individuals and they advise institutions on that. But, Canadian Value Momentum Fund, the U.S. Dividend Advantage Fund, they've got an income fund for institutional, a whole range of things, and a balance fund too. So they manage a lot of money. But James Thorne is their chief strategist, senior portfolio manager. I got a million more questions for James when we come back right after the break. By the way, got a couple of emails during the break asking about Janet LePage, who talking about real estate. She gave a specific example of Arizona. Well, she's giving a seminar in Vancouver on November 10th and in Calgary on November 16th. If you go to Money Talks, you'll see it right there under Janet's picture, and get more information by just simply going to moneytalks.net. November 10th in Vancouver, November 16th in Calgary. On the line with me right now, and really enjoying this, with James Thorne, Chief Capital Market Strategist, Senior Portfolio Manager for Caldwell Investment Management. James, can we just sort of try and wrap it all together? I mean, as I love your global look, first of all, because I was talking about this earlier, that it's these global variables, and it's easier to describe that now, or at least explain. I mean, people in Vancouver know full well about capital flow coming out of China and going into the upper end of the real estate market, so makes a little more sense to them. Or we could have gone to the subprime crisis in the States, but of course had huge reverberations in Canada, still is having those reverberations with our record low interest rates. So I just think that's such an essential approach to the markets. But I was hoping maybe let's bring it down to the individual now. What kind of themes and things should they be looking at for their own money? Okay,
so let's go with first thing is the global economy is moving from an analog economy to a digital economy, right? The internet is transforming the global economy, and it's making a lot of our jobs redundant. We are only in the first third of a 3-act play. This is going to last another 20 years. This is no different than the tractor, electricity, what have you. So you've got to look for companies that are going to be innovators. So think of a Facebook, think of an Amazon, think of Alibaba. Those companies with leading innovators, you need to understand that the Internet of Things global initiative is just beginning. 2, the only way we get out of this is we either have to grow, 1, or for the economy, this is called secular stagnation. We can grow or we can innovate. And if the innovation we're talking about now is taking jobs away, then the only way we can really do this is open up a new other area of the world. I gave you Eurasia. That speaks to our policymakers going to cut capacity out. And 3, inflation. You need to build your portfolios for inflation. And 4, when you're in this low rate return environment, when you have a period of time, when you've got the S&P 500 down 8-9 days in a row, a historical event, and you're concerned about what's going to happen, once you get certainty about what's happening after the election and the market rallies substantially, that is a gift for you. You're going to get gifts every year, 1 or 2 times a year, where people think the end of the world is going to come, and you need to position yourself to take advantage of that. And lastly, I would say, and just to calm everything down, is we have seen all of this before, and they know that. And we talked about secular stagnation. Here's a quiz question I want to leave with you and for your listeners. In The Wizard of Oz, the book, The Wizard of Oz, not the movie, what were the color of shoes of Dorothy's? And they weren't ruby. Okay? And the reason why I say that is this rise of popularism, this deflationary environment, was exactly the same, what it looks like coming out of the American Civil War when the West had been opened, the trains had been spent, excessive amounts of debt, and you had a rise of populism. The Wizard of Oz is an allegory. It is a story with a hidden meaning, which talks about the fact that we need to structurally change this economy. And the way you get out of it, where Dorothy's slippers was to add silver to the monetary policy of the United States. My point is, Yellen knows this, Draghi knows this, Fisher knows this. They know the solution. They have to politically work their way around it. Position your portfolio for that. And I do not think lightning is going to strike twice. I think we have had the financial crisis of our generation, and yet there are going to be times when they walk us up to the brink and scare the living daylights out of us. Look, and that's what I would say. And the last thing I would say is find yourself a good financial advisor, because I do this all day long, 7 days a week, and I find this very difficult. This is the most treacherous markets I have ever experienced, and I've been in the business since the late 1980s.
Absolutely fabulous, James. And this is why we put these interviews on moneytalks.net. Worth a re-listen to. James Thorne is Chief Capital Market Strategist, Senior Portfolio Manager. A great job for Caldwell Investment Management. And I might add, the keynote speaker kicking off the World Outlook Conference this year.